Welcome to today's webinar on changing fair lending regulation, the role of artificial intelligence and data. This is our third webinar in our fair lending education series, presented by Exanica and its partners. In the last two webinars, we had almost 400 different executives, compliance officer, people dealing with technology in compliance or data in compliance enrolled. And they learned about the impact of fair lending in the new Biden administration, about changing regulations. We also learned about effective fair lending with the power of data. Now, in this session today, as apparent with the latest news, we will be focused on few key changes, sentiments, and perhaps reactions in the industry as well. But we will also give glimpses of how data and artificial intelligence can play a significant role and perhaps some of the challenges and benefits of the same. We do have white papers on each of these topics. If you have not received that in the past, please reach out to us and we will be happy to share that with you. More importantly, as a result of these webinars, we have been having various discussions with executives in terms of understanding their objectives, challenges, goals, and we appreciate that more so. And these webinars is just the first contact point or touch point for us to connect. Now, more importantly, in the later part of the year, when we conclude this year, we are going to speak about an interesting topic we have heard from the industry, which is how are regulators responding and acting upon, especially in 2021. How the supervisions are going, examinations are going, how Hexanica and its partners are helping financial institutions to respond to some of the examinations. We have found sometimes the regulators themselves are not using complete data, accurate data, or some of the times the calculations or the data analytics around redlining is not as complete. And we would be sharing those experiences in our concluding session of 2021. Now, without any further delay, let me start introducing the panel today. We have Michael or Mickey Marshall from ICBA. He is the director of the Regulatory Legal Affairs at ICBA, where he promotes ICBA's position before the policymakers and advises ICBA community bankers, typically on regulatory and industry changes. He has been a frequent speaker at industry events, including the CRA and Fair Lending Colloquium. We also are honored to have Bob Brown. Bob is an experienced banker with 40 years of industry experience in a broad array of areas within community banks and credit unions. Now, the past 20 years, he is a consultant to financial institutions nationwide with regard to strategy, M&A, operations, payments, information technology, compliance, and lending related issues. He has fantastic leadership skills. More importantly, when it comes to how to be ready for examinations, how to be ready if there is an examination, and how to answer is something that we very deeply collaborate with Bob. The most interesting fact about Bob is he was a co-creator of Check 21, and he is currently strategic advisor at Twizzle. I'm also honored to have my colleague Arun Iyer. He is the Chief Product Officer at Hexanica. Arun is a business and IT leader for the last 22 plus years in the banking and financial services industries. His focus is product management, product strategy, development, operating model, architecture, process optimization, information management. Arun has a key interest in building innovative products and, more importantly, taking these innovative products to credit unions, community banks, and help them to simplify their data management and compliance and other related issues. He also helps us with a lot of go-to-market and sales functions as well. Last but not the least, I'm grateful to introduce Justin Mussolino. He is the CEO founder at Twizzle. He is an experienced compliance training professional with over 20 years of creating, developing compliance training, which is key to especially financial institutions to deal with these changes around regulations, data. And he also has liaisoned with regulators and also identifying gaps, opportunities to improve how the overall risk management strategy in an enterprise. Justin will moderate today's event, and without any further delay, let me hand this over to Justin. Justin, thank you very much, and please take it over.
Thank you very much, Yogesh, for that phenomenal introduction. I want to welcome our esteemed panelists today, Mickey, Arun, Bob. It's great to be here with you. Always a pleasure. And I want to thank everybody for attending today. It will definitely be worth your while. Now, before we get into the agenda and stimulate our panelists for this discussion, we're going to get into a poll question first. As Yogesh mentioned, we got a couple of poll questions throughout, but we'll start the first one now. How much do you know about 1071?
Swarup, I'm not able to vote. Swarup, if you can change.
I think hosts and panelists cannot vote.
Okay, got it.
We'll give everybody another 15 seconds to respond. I always like when we do a countdown for the poll. There we go. So majority don't have any idea. I know a few things about it, and I know everything. Well, if you know everything, we'd love to have you on a future session. That would be very helpful. You know, for those of you who want to learn more, this will be a phenomenal session to do that. With our experienced panelists, we'll go through the ins and outs and describe it in detail. Also, what Yogesh mentioned at the beginning, the white paper was disseminated. And if you have not received it, please reach out to us and we'll forward you a copy. We'll try to cover as much of what was contained in the white paper, but there's a lot of additional details you could definitely benefit from. So we're going to kick this off now. Now, with the proposal from the CFPB, which I believe was just initiated on September 1st, 2 weeks ago, you know, this is an amendment to Reg B of the Dodd-Frank Act. So let's get into a little bit more detail about it so we can go through the nuts and bolts. So what are the new changes of 1071? Who wants to take the first stab at that?
Sure, I can start. So Section 1071 of the Dodd-Frank Act was basically designed as a small business data collection provision. It's something that was sort of controversial at the time of its adoption. In fact, it wasn't in the text of the Dodd-Frank Act until the day before the final vote. So it's something that was snuck in sort of at the 11th hour. And it's something that has been, you know, an ongoing rulemaking literally for the last 10 years, basically putting off the date that this rule is finally implemented. However, as a result of a court decision in California, a court finally set a deadline of the end of September. The CFPB came out with a proposal a little bit earlier, September 1st. But basically what Section 1071 does is it requires any financial institution that originates more than 25 qualifying small business loans a year, and those are small business loan under the proposed definition is a loan to a business with less than $5 million of revenue. It requires you to collect certain racial and demographic data relating to the characteristics of that borrower. Obviously, you know, this implicates a lot of banks, implicates a lot of credit unions, a lot of non-bank lenders, because that threshold of 25 loans is a very low threshold. We're concerned about that. One of the things that this is going to lead to is this data. If banks don't understand sort of the pattern of who they're lending to, this may lead to increased fair lending enforcement because it's going to equip the regulators with a new data set of, you know, the characteristics of these small business loans, whereas now the demographic data for that is largely unavailable. Bob, is there anything you want to add about that?
Yeah, a few things. So the Dodd-Frank Act is the gift that just keeps on giving all the time. The loan types included under this include credit cards, which most people don't know that, but it does not include leases. So that's where the defining line happens here. The scope here is different. It's oral or written requests in accordance with your procedures. And so it's very important that your procedures line up here because they may define what your exposure is here. But this could extend to somebody who's sitting in a soccer game with the potential borrower, and they say, I'd like to take out a loan. You may have tripped the trigger that this is now a qualifying transaction. The requirements in this document restrict certain people like loan officers and underwriters from access to some of this information. So you may have to prove a negative that they're not getting access to some of this information. Unlike the PPP, there is no expiration date on this thing. So this could go 50 years from now. So that you need to take a long-term view of this application. This is not a 1 or 2 month program. The data will be published by the CFPB and be made public with a few minor exceptions, but you can expect to see that some individual law firms may be looking at this data, and you may be exposed not only just to the CFPB, but some third party may be able to use this data against you. The data will be evaluated both subjectively and objectively by the CFPB and the other regulators. So there's going to be a lot of interpretation of this data and how they feel about things. And you can expect the CFPB to put pressure on organizations as this thing is rolled out and as some of the first exams occur under this program. Justin?
Great. Thank you, Mickey. Thank you, Bob. Great explanations. So the biggest thing with any rule, regulation, proposal, whatever it is, we have to determine who is impacted, because that message needs to get down to the workforce. And it's going to basically, everyone's going to be impacted differently. So let's focus a little bit more on who is impacted within a financial institution. Bob, I believe that's you.
Yeah, we think that it's going to be everybody that's involved in that customer relationship for small business. So it could be the business development people, it could be the branch people, it could be the marketing people. You're going to have IT involved, and you're going to have your underwriting staff involved. So many people. So it needs to be a collective effort here inside your financial institution.
Yeah, and I would just add to that. Right now, every institution that makes more than 25 of these covered transactions is covered by the rule. Under the previous administration, they had a SBREFA panel. It's a small business panel, and they came up with a list of suggestions after that. After that panel, that administration suggested a $200 million exemption threshold. That threshold has been sort of abandoned by this administration. And so I think it's fair to say that for most sort of traditional banks, you're going to be implicated by this regulation because the new threshold, that 25 loan threshold, is extremely low. Now, it's not a guarantee that that's what will end up being finalized, but currently the exemption threshold is basically almost non-existent. And one of the other things that I wanted to add about the regulation also is, by this proposal, banks will have 18 months after the date of publication of the rule in order to comply. And so that's, for a rule this complex, we also think that's a very short turnaround period. So it is something you want to be thinking about how you're planning on complying with this regulation now.
Great. Thank you, gentlemen. Perfect responses. So we're going to shift gears a little bit and get into AI. Regulatory agencies understand the impact and what it could do for a financial institution, lowering costs, looking at underserved groups, a lot of good benefits. Arun is here to give us a little bit of those details as far as what are the best benefits from using AI in, say, fair lending.
Right. Thanks, Justin. So, the basic premise of fair lending is that is to ensure equitable access to credit to everybody without any bias towards any prohibited classes, right, by race, ethnicity, age, gender. Right? But if you look at statistics, and I may be quoting something which is dated, there are more than 45 million credit invisibles in the United States, right? So these are typically people who are from some specific race and ethnicities, low-income groups, immigrants, recent immigrants, young people. So there's a huge population that does not get access to credit because they don't have the traditional credit scores available, right? They don't have a file, or they have a limited file. And that's the segment really that will benefit out of using artificial intelligence. And research has been done, and regulators in their working groups have quoted some of this research that by using alternative data, and by alternative data, I mean cash flow data such as income statements, right, expenses, utility bills, overdraft information, basically cash flows belonging to the end user, the end creditor and borrower, can be used to build AI models and make credit available to them, right? Even though they may not have a credit score. So the role of AI is really in making credit available to a population that was erstwhile not being served by the traditional model.
All right, thank you very much, Arun. So not everything could be positive, right? We have to look at the opposite perspective, right? So Arun, what are the downsides from this?
Right. Yeah, so absolutely, right? So while there is a whole segment that believes that AI should be increasingly used, there is also an argument against AI, right? So the whole purpose of AI is that it is very objective. It eliminates the subjectivity that is there in the traditional manual processes, right? But the fact of the matter is that AI uses data, a lot of historical data, and there is no guarantee that there isn't inherent biases in these data. And because of the objectivity of these models and the way they are modeled, sometimes these biases may actually get accentuated and may result in what in the fair lending parlance is called as disparate impact, right? So that's a big downside to AI if it is not modeled correctly. If the data that goes into these AI models are not used properly, they may actually result in algorithmic bias, as they call it in the industry.
Good question. Now, talking about models, what can firms do to ensure that their AI models for credit underwriting are transparent and empirically sound?
Right. So taking ahead from what I said, right? So any AI model follows a process, right? So the first process is actually building out the model, where you have to look at a lot of historical data. And this is where I think the firms need to put in the maximum effort to ensure that the quality of data is good. There aren't any inherent skewness in the data. For example, if you are building a model with very limited information about a particular ethnicity, race, class, right, then it is going to not adequately model that particular variable, right? So building out the model is very, very important in the process around that. The second thing is, once the model is built, it has to be rigorously validated and tested, right? So not only does the model have to be validated by a third party, but you need to test it with a lot of historical data to ensure that any of these disparate impact biases are not introduced. And third aspect, because there is this whole requirement of the regulator to explain when a loan is denied, the explainability of the model is very, very important. So you need to document exactly what the model does, what are the data inputs that go into the model, so that whenever an adverse action happens and you have to submit an adverse action notice, you are able to at least identify at a high level what kind of variables really cause that loan to be denied.
Thank you very much, Arun. Bob, you have anything to add?
Yeah, one of the first concepts I learned in IT way back in the late 1960s was garbage in, garbage out. And that's certainly going to be an issue here, that we're now introducing several new concepts we've never had to track before, including one of the most important ones under 1071 is the ability for borrowers to self-describe themselves. So you won't be able to just look at the borrower and decide who or what they are. You're going to have to ask them, and they're going to optionally get the option here to describe who they are, which could be a challenge for most banks. We're not accustomed to that. We're going to find that the traditional core providers are going to have a difficult time keeping up with the changes here as the terminology in society changes so rapidly now. Core providers have a very poor record of being able to change on a dime and be ready to adapt new vernaculars. In addition, we're going into an area here where we don't have a rich history of various types of data. So we're going to be creating formulas and analyzing data that we really don't have a historical track record with. And so there's a greater opportunity here that we could make some mistakes, unintentionally in most cases, but we can make some mistakes because we've misinterpreted the data. Justin?
Thank you, Bob. Thank you, Arun. But Bob, don't get too comfortable because the next question is coming at you. Now let's look at a different side of AI, the risk and rewards with lending, right? So Bob, let's start off with the risk first, and then we can build up to the rewards.
I think the first one is that we could inadvertently trip over a compliance problem here. It's going to be very important that the financial institutions really go back and review their policies and procedures, because this thing will be evaluated as both in terms of how the procedure is constructed, but then how well they comply with that procedure. And the ability to trip this trigger with an oral request makes this much more difficult, because it's difficult to define when did that occur and to document the fact that it occurred. It could occur in a social setting, and then you can have a discussion later on, but your reporting requirements started when they initially said, I'd like to take out a credit card, or I'd like to take out a loan to buy a car, whatever it might be. The business development process could become robotic. I mean, bankers tend to like to tell everybody they can differentiate because they are so close and familiar with the customer, but their conversation with the customer may need to become scripted here so they can accurately define when they trip this trigger and when the reporting requirement kicks in. And they'll have to make sure that they collect certain pieces of data as soon as they do that. So that's really important that, in the past, you waited till you had an application. You're going back upstream here and collecting this data earlier on. The political climate here, as Mickey mentioned here, we can have a change in administrations, and it could change the interpretation of this regulation. And again, we have to take a 50-year time frame on this. So, it's obvious we'll probably have changes in administrations over time. You've got changes in societal norms and what's accepted, what's not, and how we describe all those different societal norms. And that's all going to have to be incorporated here. And the banks are going to have to be much more sympathetic and understanding of what these are, and educate their staff on what they need to look for. It's likely that as the alternative data is captured, the individual regulatory agencies may start asking the banks to provide this information outside of the 1071 requirements if you're either capturing alternative data or if you're computing alternative data and you come up with a result. Anything that's used in that whole process is subject to an examination. And then finally, the banks may increase their profiles inadvertently here just because of the lack of understanding of what's going on here. A good example right now is this buy now, pay later trend, that at least one study has come out that says you increase your risk, and you both of default, of late payments, and then the individual gets credit score changes downward if they use that product. Justin, back to you.
Thanks, Bob. And to the audience, we want to provide the pros and cons with every aspect of what we're talking about to give you more information so you can make those educated decisions. If you have any particular questions, I just want to remind you, place it on chat and we'll get to them during the duration of this webinar. But next, we're going to go to poll question number 2. It's going to be posted in 3, 2, 1. All right, my count's off a little. There we go. Question number 1, do you make more than 25 loans per year? That includes credit, inventory, farm, small business, and this excludes leases? And if you choose yes to this, how prepared are you? Give everybody 20 seconds.
Justin, just to add while we are getting the poll answers, this question is based on the criteria or criterion set by the regulators that if you have more than 25 loans of these types, you will come under the purview of the regulation.
Great. Thank you, Yogesh. Okay, let's close the polls and show the results. Okay, 25 loans per year, 66% said yes, 26% no, and unclear 8%. Of the 66%, 38% are somewhat prepared, 14% not prepared, and we don't know as of yet. Okay, 48%. All right, thank you all for answering our poll question number 2. So now we're going to get into alternative data a little bit. And the best way to describe this is really the emerging pattern of thought that underwriters go through for criteria methods of loans that are inherently discriminatory and need to be reevaluated as well. So it's a great use. So question is how alternative data plays a role in all of this. Who wants to first go through the different types? Bob?
Yeah, just a second.
No problem.
There, we're really talking 2 subjects here. So under the 1071, there's about 25 data fields that you're going to be required to collect. And many of those are fields that you've never been required to collect before. On alternative data, you might be looking at utility bills, cable TV bills, mobile phone bills, the payments, the borrower's rent history on payments, car payment histories, where they're located from a geography perspective, their race, their gender, and their sexual preference. And many of these are elements that we've never dealt with before because we've been told not to collect that data. So the various combinations here will be challenging for the financial institutions for several years.
Okay, so Arun, how could it be used effectively?
Right. So I think Bob covered the 1071, and if you look at the other aspect, which is the AI models itself, right, or use of alternative data in the AI models. I mentioned earlier, right? So there are cash flow variables which are typically available through the borrower's bank account statements, which is their pay stubs, other income, other deposits, their expenses, utility bill payments, even information such as any overdrafts that they have. All of these are data points that are typically used in these kind of AI models. Very often, banks also use other non-cash information, right? The education and a few other demographics of the user in the modeling process, right? So all of this traditionally classifies as alternative data. Now, of course, as I said, how much bias is inherent in this data is something that the banks need to measure and evaluate as part of the modeling process. Somebody did ask a question, and I'll probably answer that question, that how can you be sure that the inherent bias is filtered out, right? And it is not an easy process. It's an iterative process. Typically, there are various modeling techniques itself that allows you to sort of improve the quality of data, right? There are metrics that are called fairness metrics that are measured through that iterative process, where you introduce different variables and see whether it impacts the fairness of the outcome adversely, or if you remove a variable, what is the change, right? So you measure these fairness metrics, and it is a highly iterative process, after which the use of this alternative data in the model really makes sense, right? From generating a particular expected outcome.
Cool. Thank you very much, Arun. And thank you, Bob. So we're going to also do another poll question now, which should be up in 3 seconds. We'll give everybody about 20 seconds to answer, and then we'll go over the results. Are you using AI in current lending process? Okay, another 10 seconds and we'll reveal the results. Okay, let's close the poll and show the results. Okay, so yes, 25%, on the heavier side, no, 45%, sometimes 12%, and planning to 18%. Great, thank you all for your responses. So another important aspect that we want to cover is the regulatory point of view, the guidance they prescribe, any type of information that helps us within financial institutions to really guide the process and modify every aspect of what we do. So Mickey, I'm going to pick on you for this one, with your regulatory experience. What is the regulator's point of view and what's the future of AI? And I guess let's talk about their position with all of this.
Sure. So earlier last year, the different regulatory agencies came out with a joint request for information, basically trying to get a broader picture of how financial institutions currently use AI. In that request for information, there was some, I think, interesting hints to what their approach for how they supervise the use of AI by banks is. I think the big takeaway is regulators are aware that there's potential benefits in terms of increased access to credit, in terms of saving on underwriting costs, increased efficiency, but they're also aware of some of the risk. They're aware of the fair lending risks, they're aware of data security risks. So I think as a general rule, where possible, they want to try to use existing regulations. They want to try to use, Reg B of the Equal Credit Opportunity Act, the Fair Credit Reporting Act, Fair Housing Act, where there are existing laws and existing regulations that sort of overlap with the use case of AI, they want to try to use those existing laws. They haven't proposed any AI-specific regulation at this time, but in their RFI, they did note that there may be some areas of AI that are a little bit different than existing, what they currently supervise. And so those unique areas were explainability, data usage, and dynamic updating. And so if we see a regulation about AI, I think it'll focus on one of those three areas. And just real quickly on what those are. Explainability focuses on, your model is producing these outcomes, approvals or denials of applications. So do you know sort of what factors it considers and what weighting it gives to those factors? And can you provide sort of, justify the decisions your model makes? Data usage has to do with the fact that, because you're considering alternative data and data points you haven't looked at in the past, does this increase the risk around consumers' personal information being exposed, either to hacking or sort of being misused by financial institutions? And then third, dynamic updating. I think this is one of the really interesting ones, which is that, certain AI models can actually, improve and learn over time, and see what outcomes produced favorable, this creditor repaid, this one didn't, and improve themselves based on that input. But then the question becomes, if your model is doing that, is improving itself in real time, going back to explainability, do you still know the factors it's considering when it's making these underwriting decisions? So I think those are the three sort of risk areas that regulators have identified as this is what makes AI different than current approaches. But I think for the most part now they want to use existing regulations.
All right, so follow-up question. Mickey, don't go anywhere. I have another one for you. So in this time of COVID, are banks being more lenient in these times?
Well, so I think examiners have been more lenient. I think a lot of that, right? A lot of examinations have been done off-site, and I think that's something examiners will continue looking towards in the future. How much do we want to do off-site versus actually, on the physical premises? But yeah, I think it is fair to say that, with regard to fair lending, CRA, things like that, there has been more latitude given during the pandemic. And so I do think it's possible or even probable that you may see an increase in enforcement actions around fair lending going forward, just because, the administration has made it clear that that's really one of their priorities. I mean, I think the acting director of the CFPB made a comment that I thought was interesting, which is that he wanted to see a robust fair lending docket. So they're definitely, looking for these kind of cases to bring.
Cool. Thank you very much, Mickey. So we're going to get to the next part, which is equally important. Every rule, regulation, proposal, they contain a lot of information, but we need to disseminate this information to the masses and make sure people understand the implications on their positions. It could be an individual, a team, or it could be a department. But you need to have a plan and figure out how this is going to work. And every time that I do this, for anything that comes out externally or even internally, you got to be methodical in your approach. The one step that I take at the forefront, which is obviously important, is understand the rule, regulation, or proposal. Very detailed, because the research you do, it's like Bob said, garbage in, garbage out. You have to be very instrumental on how you get this information. What are the scopes of a new rule or the scope of the changes? Now, this is still a proposal. So one thing I do want to say with this, you could be proactive or you could be reactive. I always want to get in front of this because it takes time to develop a plan. Second part, you really want to figure out, as we discussed here, who are the impacted areas? Again, it could be very granular in detail. It could be a team, a department, or it could be multiple departments. But you need to figure out that. So with the education that you're taking on with this rule change or new rule, this all feeds together. So once you have this information, you want to discuss it internally so you can get a little bit more educated on it. Potentially first, let's say first, I always discuss it with members of compliance or risk areas. Sometimes even business aligned compliance officers, because they represent the business in different capacities. So I want to get their take on it and see the implications for everybody involved. And then I always go to the business. You want to give them the heads up about what's coming down and educate them, usually the leaders, on how this is going to go, the approach, the rollout, everything. So once you do that, you really want to think about what is your plan? How are you going to get this out to the masses? Pre-issuance, post-issuance, right? So all the research that you conducted and all the discussions you had are going to feed into this overall plan. And sometimes you have to get very granular with the information depending on who's impacted, or it could be high level, or it could be a combination of both. Now, some of your training or communications have to be very customized, because remember, people are going to be taking this information and applying it on their jobs. So you have to give them as much as they need to perform it. If not, it's going to pose a huge risk. And that risk is going to have trickle-down effects to the entire organization. So once you have your plan laid out, you have the rollout, everything leading up to the issuance. Design that as far as communications and training, as I discussed. Post, you have to refresh this information from time to time. People will lose it if they're not using it every day. So design your plan with the pre and post in mind. So you continuously feed this information or refresh it when the timing is right. And then, with the refreshing, you want to get engaged and also get the feedback. What's working, what's not. Performance measurement is key. If you have the right performance measurement metrics, you could figure out what are the lessons learned, what do I have to change going forward to make this more productive with everybody's time, because time is a huge factor, because more time involved with training communications, it takes away from people's job. So you have to keep all of these things in your mind when you're developing this plan and you're having these discussions, so it could be very well thought and methodical. So this is really important with the approach, because again, a rule is a rule, proposal is a thing, but if you don't get it down to the masses and you don't do it right, it could have really big risks for your organization. So on the technology end, I'm going to let Arun run with this part because he's more knowledgeable than I am in this area.
Technology side, and I think we covered some of that, and I'll keep it brief, is all of this, the basis of all of this is data, right? So it is the most important and basic requirement is to have a very robust data infrastructure where you get all the data sources from whatever, right? If you're using alternative data, which is that alternative data source? How do you ensure it is of good quality? How do you eliminate any biases. So the entire data and modeling infrastructure is where most of the effort and investment is required to build the basis of a strong AI-driven ecosystem. Back to you.
All right, thank you, Arun. All right, so let's get into the process a little bit. And I'm going to pick on Bob with this because he is Mr. Process. What about the interactions between different departments and the restriction of data? I think, Bob, you could talk the best on that note.
Yeah, the place to start here is your policies and procedures. I mean, the way the regulation is written under 1071, they're going to evaluate your policies and procedures. That those are not spelled out in this regulation. So it's important, if you want to have a good examination, to make sure that you've not only defined it, but you've also educated your employees as to what's acceptable and what's not acceptable. So maybe you can't have a discussion about issuing a credit card to somebody at a soccer game with in a casual environment. Maybe you need to say, I have to shift that to some specialist, or we have to do that under certain conditions for this to count, but don't let the discussion proceed beyond a certain point if you don't want to trip the trigger here on compliance. Because this could be any employee in the bank, that if you have an informal procedure that allows anybody in the bank to start that discussion, that's when the clock starts. So it's going to be important that not just your traditional business development people get involved, but that everybody gets involved. And the board needs to be involved in overseeing this policy and procedure update. I mean, this should not just happen in a vacuum down at the low level working level. I mean, the committee we've discussed should be educating the board and making recommendations with regard to both policies and procedures and systems technology that we're going to need to employ to make this all happen eventually. So one thing, Justin, you didn't mention, because you ticked off a bunch of my things, is I think you need to have a customer awareness program. I mean, I think that's an optional, but I do think that, you know, this is a great opportunity for some of the banks and credit unions and other lenders to expand their book of business, especially in times like now when we've got excess deposits, and grow their book of business with new alternative types of loans. So back to you, Justin.
All right, thank you very much, Bob. What about the examination experiences? Do you want to touch on that?
Yeah, I think it starts before the examination. I mean, what's even hinted in some of these documents is that the examiners are expecting the banks and the credit unions to communicate with them throughout this entire process. So if they're looking at bringing in AI or alternative data, alternative formulas, they need to discuss those in detail with the examiners and not surprise them when they show up for an examination. Then they find out that you've got an AI system involved now. So the last thing you want to do is surprise your examiners. So constant communication as this whole thing shakes out, I think, is important.
Yeah, I think you touched on it. It's a relationship you have with the examiners that you really have to establish. It's better. It's not a good idea to be combative with your examiners, because you're really not going to get anywhere. And work with them, and that relationship is always key. All right, gentlemen, this has been great. What we're going to do now is we're going to turn to some questions from the audience. First one from Jessica. How could the oral requirements be audited? We're relying on the input of relationship managers, LOs, to document all conversation, but there's no control point to audit against. Customer complaints is one. Who would like to take that one?
I'll take a first shot. I mean, I'm concerned about that. That's why I think, you know, good policies, procedures, and training is important, because people need to know when they've crossed that line and we're now in a situation that's covered by 1071. And, you know, there's really no way to audit it, but the examiners could send in somebody. They don't do it today, but going forward, they could send somebody in to test your defenses. And, you know, just like you do secret shopping on the business development side, you could, you know, the examiners could secret shop a bank and see how they responded to an oral inquiry for a small business loan. So I think it's important to have those controls in place.
I'll say, I mean, this has been something, we've heard from bankers a lot about is, when is that trigger that this is now officially an application? When does that start? And I think there's a lot of real concern, that this is going to become, the result of this is that, small business lending, which is now a pretty informal process in some cases, is going to become sort of forced into a box of it has to be this written application. Hopefully the final regulation sort of bakes in some of that flexibility to allow for that more relationship lending. I think it's right now, the way the current proposal sits is, if your bank would consider that, this is an application using your normal processes, then that's when the line is tripped. But it's definitely going to be something we're going to need sort of more guidance and more clarification on as we get to a final rule on this. So I'm sorry, that's not really a great answer, but it's an area under consideration, let's say.
It is what it is right now at this point in time. Bob, go ahead.
Justin, you may see some social action groups that are getting involved here where they're going to test the boundaries here. You may see some law firms that test the boundaries here, where they could document a case. I walked in and I talked about applying for a credit card and it never went anywhere, and see if it got reported, because all this data will be publicly available.
That's a good point, Bob. And thanks for the explanation. Thanks, Mickey. The next question is from Jim. One of the challenges we see deals with single-purpose LLCs that we may loan to. These entities have no income. We rely on the underlying LLC's owner's income from other operations to underwrite the loan. That underlying income very often would be in excess of $5 million per year. With that, will the loan to the single-purpose LLC be considered a small business loan? That's a mouthful.
Yeah.
I think that's up for grabs. We're going to need to see the clarification that comes down from all the questions you get. That's the problem. We're speculating now.
Yeah.
What the final document is going to say, but there's going to be an awful lot of what if and what if scenarios that we're going to have to figure out the answers to in the next 90 to 120 days.
Anybody else want to add anything?
No, I would hesitate to get down into that level of specificity right now.
Right.
All right. Thank you, gentlemen. I think we have another question from the group. If anybody has a question.
There's one question on the chat from there are what are the recommended data resources available that are preferred or deemed as acceptable by the regulators? So again here, and Bob, please feel to add. There is nothing prescribed per se, right? So all the working group notes and any of the regulatory guidances only talks about typical alternative data sets, right? So as I mentioned, it talks about cash flow oriented data sets, which could be deposit statements and other account information of the customer, and of course with the consent of the customer, especially if it is being used by a lender who does not hold that account. There has to be some kind of consent mechanism by which that data can be used. And then of course there is other publicly available data, which is or you could get it directly from the lender, their education background, other demographic information. So this is what is prescribed at a high level. What each firm may use may vary, but as Bob rightly mentioned, that at the end you have to be ready to be scrutinized by the regulator if they ask, right, what a particular variable implication is in determining an outcome of an underwriting process.
Thank you, Arun. Just checking the board to see if we have any more questions. A lot here.
There was something right on top as well, which Tracy 1071 proposal also includes all applications for SBA, not just originations. This changes the industry data and reporting. This feels like the biggest lift in the proposal. Your thoughts? Nikki or Bob, is that something?
Yeah, one of the interesting factors here is going to be is that we went from less than 1,000 banks and other financial institutions participating with the SBA to now we have thousands of institutions participating. And so it's going to take us a while to shake this whole thing out and figure out what all the nuances are in this whole data collection process. I think that you're going to see that this becomes an extension of most banks' PPP efforts to where they become full SBA lending organizations as a result of this, because they're going to have to put many of the controls and data collection efforts in place anyways to satisfy the needs of the CFPB.
Right.
But again, that's speculation.
Yeah, and I would just say, I mean, too, one of the, to compare and contrast this with PPP, in PPP, we had that voluntarily borrowers could turn over their demographic information. And the response rate to that was, very low. I mean, less than 20% of people turned their demographic information over voluntarily. With this, it's a non-voluntary process. It's something that you're going to, have to collect and have to report on, and that is ultimately going to be made public. So, as comparing and contrasting PPP and this, that's the difference. Is not this information in the past, it may have been even illegal to ask for, but now it's going to be mandatorily collected. So that is a major change.
Right.
Right. And I think that follow-up question, which is related, I think Elizabeth Fair has asked, the major issue that I see is lack of commercial loan application and loan origination system that contains the application process. And to an extent that is true, because that given the scope of loans that will be covered, you rarely will see that there is one application where all of this information can be captured, right? So banks will have to evolve a process by which at least some of the information, especially the demographic information, is captured upfront, maybe at the time of customer engagement in the CRM systems, and then get it down to your loan application systems. There are other issues that Bob mentioned that you need to segregate as to who can see this data within your organization and who cannot. So there is a whole lot of complexity around it, especially when it comes to technology. And I guess none of it is clear at this stage. Only when we see the fine print, we would know that.
Yep. A lot of speculation. All we could do right now. Okay, I think at this point we can close the session. And gentlemen, thank you very much. And Yogesh, I'm going to pass it to you for the closing comments.
Justin, thank you very much. I think this was a great session. You covered a lot of aspects around changing regulation, changing data requirements, changing processes, people, lot to cover. And I see, we have addressed most of the questions. Some of them we have answered in the Q&A or chat sections. People are welcome to go and read if you have not, it is around how to filter bias in AI and the reliability on the models and etc. And I think one message that we got from the panelists is prepare, and prepare, right? Means don't wait until the deadline comes in of submission. I think the regulators are serious. So if you have any questions, please feel free to reach out to any of the panelists. You will have to start sourcing the data in advance. You cannot start sorting at the end of the year if that data is required. You will have to plan right now. You will have to anticipate some of the changes. Then the second piece I think we mentioned, and which was focus of this topic, was around artificial intelligence. And one thing that we did not mention, that yes, some of the financial institutions are already using AI or considering, but more importantly, the regulators are actively looking at it, and they are using it, or they're about to use it also. So it is not just the financial institutions, but I know FDIC had a recent some innovation activity around AI modeling, transparency, inclusiveness using AI. And when you say that, the alternative data comes into the play. What my message is, you don't need to be scared. You can make the data models transparent. And Mickey mentioned about explainability, data usage, and dynamic updates. There will always be feedback loop and updates, but all that can be very transparent. There's at the end of the day, it is a code, and sometimes you could have, we call that as supervised machine learning, that updates the code, and you can say, yes, the update is right or wrong. So you can take care of the biases coming out of AI, and control that. So there is nothing to be, if I can say, scared of. Everything can be controlled. At the end of the day, it is a code, and we can manage it if we do it in the right way. The last piece that we touched upon, and we are going to have a follow-up session that I mentioned earlier, is around examinations. What is the thought process of the regulators? Whatever examinations, as Vicky mentioned, they may not be as active during COVID times, but whatever examinations the banks, financial institutions are facing right now, how essentially we are giving feedback on those examinations, or financial institutions, how we are working with them. And not only that you wait for the examination, as Bob mentioned, there are a lot of things you can prepare in advance so that you are at ease if at all there is a supervision or examination. So we will be covering that aspect more so in the next webinar that we will touch upon. We will also be summarizing all the 3 topics that we did around changing regulations, data, and artificial intelligence. And I look forward to having similar session again. Justin, Mickey, Arun, and Bob, thank you for a great session, well attended, and we appreciate your time and inputs.
Thank you.
Swaroop, we can close. Thank you.